Picture the US government with a massive credit card, one with a nearly limitless spending limit. Every year, the government swipes this card to pay for the things that keep the country running, programs, services, and infrastructure that touch the lives of millions of Americans. This spending covers everything from building highways and maintaining bridges, to sending out Social Security checks, funding schools, supporting the military, and providing health care for seniors and veterans. But here's the catch. The money collected from taxes, income, corporate payroll, often isn't enough to pay for all these expenses. This shortfall is called a budget deficit, which means the government is spending more than it brings in each year. To fill this gap, the US borrows money by issuing Treasury securities. Think of these as official IOUs, promises to pay back the borrowed money with interest at a future date. This is how the government raises the cash it needs to keep operating. Treasury securities come in different forms: short-term bills, medium-term notes, and long-term bonds, each with its own maturity date and interest rate, appealing to different types of investors. These securities are sold to a wide range of buyers, from large institutions to individual investors, both in the US and around the world. Some buyers are US government trust funds, like those for Social Security and Medicare, which invest surplus funds in these safe assets. Others are American banks, pension funds, and everyday citizens looking for a secure place to park their savings. But a huge chunk of US debt is actually bought by foreign countries, with Japan and China being two of the largest holders. These nations see US Treasury securities as a reliable way to store their wealth. Why do so many investors, both domestic and international, buy US debt? Because it's considered the safest investment in the world. The US government has a long history of paying its debts on time, making its bonds a trusted store of value. The US has never defaulted on its obligations, and its bonds are often called the global gold standard. Investors trust that their money will be safe and returned with interest. In times of global uncertainty or financial crisis, investors actually flock to US bonds, seeking safety. This high demand keeps borrowing costs for the US government low, even as it borrows trillions. Thanks to this trust, the US can borrow vast sums at remarkably low interest rates, allowing it to finance everything from disaster relief to scientific research. But what if that trust starts to crack? What if investors begin to doubt America's willingness or ability to pay its debts? Suddenly, the world's safest bet could look risky. That's when things get interesting and dangerous. A loss of confidence could send shockwaves through the global financial system, raising borrowing costs and threatening economic stability. The entire system depends on global faith in America's ability and willingness to pay its bills. This trust is the invisible glue holding the world's financial system together. If that faith wavers, the consequences could be catastrophic, triggering market crashes, higher interest rates, and a loss of confidence that could ripple across the globe. So what happens when the world's trust in America's financial strength is put to the test? Let's find out. For decades, US government debt was considered the ultimate safe haven, an investment so secure that even the idea of people dumping it seemed like a far-fetched nightmare. The world trusted America to always pay its bills, and US Treasuries were the backbone of global finance. But in 2025, everything changed. A sudden and severe trade war with China, America's biggest creditor, turned that distant fear into a harsh reality almost overnight. Massive tariffs and retaliatory measures triggered panic in financial markets. Investors, both in the US and abroad, started dumping US Treasury bonds at a pace never seen before, desperate to avoid losses. Bond prices plunged, and interest rates shot up overnight. The so-called April panic sent shockwaves through Wall Street and beyond, as the cost of borrowing for the US government soared. Suddenly, the US had to pay much more to borrow money, just as the economy was already teetering on the edge of recession. The timing couldn't have been worse, and policymakers scrambled to respond. The great bond sell-off shattered the long-held myth that US debt was untouchable. For the first time in generations, the world saw that even America's financial fortress could be shaken. It proved that global willingness to fund America isn't guaranteed. International investors, governments, and central banks all began to rethink their strategies. Trust in US policy is everything. When it's lost, so is the money. The world's faith in the dollar and in US leadership was suddenly in question. The world began to wonder, was this just a temporary blip or the start of a permanent shift away from US debt? The uncertainty rippled through every corner of the global economy. The very foundation of the global financial system was cracking, and nobody knew how deep the damage would go. the US faced a new, terrifying reality. What if the world simply stops lending? What if the trust that built the modern financial order is gone for good? The consequences would ripple everywhere, touching lives and livelihoods across the globe, and leaving everyone to wonder what comes next. Why do investors keep buying US debt, even as the numbers soar higher every year? It might seem counterintuitive, but there's a simple answer: safety and trust. Despite the ever-growing debt, US Treasury bonds are seen as the world's safest asset. Investors know that, historically, the US government has always paid its debts on time. These bonds are backed by the full faith and credit of the US government, which has unique powers. It can tax its massive economy and print more dollars if needed. The US has never defaulted on its debt, and that track record builds enormous confidence among investors worldwide. In times of global crisis or uncertainty, investors actually flock to treasuries, treating them as a safe haven when everything else feels risky. For foreign governments and central banks, holding US debt is practical and strategic. The US dollar is the world's reserve currency, used in most international trade and finance. This means countries need dollars to buy oil, pay for imports, and settle global transactions. US bonds are the easiest way to hold large amounts of dollars securely. Buying US bonds is simple, reliable, and can be done in huge amounts, making them attractive to everyone from individuals to massive institutions. The Treasury market is enormous and highly liquid, so big players can buy or sell billions of dollars worth without causing chaos or wild price swings. That kind of scale and stability just isn't possible with most other assets, especially in times of stress. For pension funds, insurance companies, and central banks, US bonds offer modest returns, but more importantly, they provide stability and predictability, qualities that are absolutely crucial for managing trillions of dollars. Investors aren't buying US debt out of charity, they're protecting their own interests, seeking safety and liquidity in a sometimes unpredictable world. But this entire system depends on one thing: trust. As long as everyone believes the US will pay its bills, the system works. If that trust ever breaks, if investors start to doubt America's willingness or ability to pay, everything could unravel quickly. The world's faith in US debt is both America's greatest financial strength and its biggest vulnerability. So what would happen if that faith suddenly disappeared? The consequences could be global, swift, and severe. Imagine if foreign governments and big investors suddenly stopped buying US debt. One day, the usual buyers just disappear from the market. Or even worse, what if they started selling off what they already own, flooding the market with US bonds? The Treasury would have to offer much higher interest rates to attract new buyers just to keep the government running. That would make borrowing far more expensive for everyone: businesses, families, and the government itself. Interest payments on the national debt would skyrocket, eating up a huge chunk of the federal budget. That would squeeze out spending on everything else, from schools and hospitals to infrastructure and public safety. Even then, buyers might not return if they've lost faith in America's ability to pay its debts on time. A failed bond auction would signal a true crisis, one that shakes the very foundation of global finance. The US simply can't fund itself, and the consequences would be dire. The government would face impossible choices, deciding who gets paid and who doesn't in a moment of national crisis. Social security, military salaries, and vital services could all be at risk, leaving millions in limbo. The fallout would be immediate, chaotic, and global, affecting economies and people everywhere, not just in the US. A US debt crisis isn't just Wall Street's problem, it hits every American home. Government bond rates set the benchmark for mortgages, car loans, business loans, and credit cards. If Treasury yields spike, borrowing costs soar for everyone. Home ownership becomes unaffordable, businesses stop hiring, and layoffs rise. The economy slows, unemployment climbs, and recession looms. Meanwhile, a weaker dollar makes imports like food, electronics, and clothes more expensive. So, as your mortgage and grocery bills rise, your job security falls. It's a triple hit: higher costs, fewer jobs, and rising prices. This isn't abstract finance, it's a direct threat to every family's stability. The pain would be widespread and severe. A debt crisis would touch every corner of American life, and it wouldn't stop at the border. When America stumbles, the world falls. US Treasury bonds are the backbone of global finance, held by banks and governments everywhere. If their value collapses, financial institutions worldwide suffer huge losses. Lending dries up, economies contract, and a global recession takes hold. The dollar's status as the world's reserve currency would be threatened. Countries would scramble for alternatives, creating chaos in currency markets. America's ability to lead in project power would shrink. Allies would be left vulnerable and rivals would seize the moment. The world order would shift fast and unpredictably. A US debt crisis isn't just economic, it's geopolitical. The ripple effects would redraw the map of global power. The stakes are enormous and the risks are real. America's debt isn't just its own problem, it's the world's. The fallout could be historic. If buyers flee, Washington's options are all painful. Drastic spending cuts would gut services and spark public outrage. Massive tax hikes would slow the economy and anger voters. Political gridlock could make action impossible. The Federal Reserve might step in, printing money to buy unwanted bonds, but that risks runaway inflation and a collapsing dollar. Every fix comes with severe side effects: social crisis, economic pain, or inflation. The 2025 bond sell-off was a warning. Global trust isn't infinite. The only real solution is responsible debt management before crisis hits. If not, America faces a menu of terrible choices, each with lasting consequences.